If your account keeps bleeding and you're blaming the market, stop right there. The truth is brutal. You are your biggest loss. One toxic habit is silently destroying your capital, confidence, and future. Fix it now, or prepare to watch your trading dream die trade by trade. Most traders wake up every single day believing they are one strategy away from success. One new indicator, one secret entry model, one institutional setup, one paid mentor, one more YouTube video, and then everything will finally click. The profits will flow, the losses will stop, the struggle will end. But here's the brutal truth no one wants to hear. You're not losing because of your strategy. You're losing because of how you execute it. This is the illusion most traders live in. They think the problem is external. They think the solution is technical. They think if they just adjust the moving average, refine the RSI settings, or find a smarter entry trigger, their account will magically transform. So they jump from system to system. Breakout strategy this week, supply and demand next week, smart money concepts after that, backtesting screenshots look amazing, demo results look promising, hope rises again. Then real money enters the picture, and everything falls apart. Imagine giving the exact same profitable trading system to 100 different traders. Same rules, same risk parameters, same entry and exit criteria, same time frames. Statistically, if the system has a proven edge, it should produce consistent returns over time. But what actually happens? 90 of them fail. Not because the system stopped working, not because the market suddenly changed forever, but because the human executing the system changed the outcome. Some will move their stop loss the moment price comes close. Some will take profit too early because they don't want to lose what they have. Some will double their lot size after a loss to recover faster. Some will skip valid setups because the last trade hurt their confidence. Others will take random trades that don't even fit the rules because they're bored. The system remains consistent. The trader does not. This is the biggest misconception in trading, believing that technical knowledge equals profitability. You can memorize every candlestick pattern. You can understand market structure, liquidity sweeps, order blocks, support and resistance, Fibonacci levels. You can speak the language of trading fluently and still blow your account. Because trading is not a knowledge problem. It is a behavior problem. Your real enemies are not hidden algorithms or secret institutional manipulation. Your real enemies sit inside you. Impatience is the first one. The market doesn't move on your schedule. High probability setups don't appear every hour. Sometimes the best trade is no trade at all. But most traders feel uncomfortable doing nothing. They open the chart and feel an urge to participate. They want action. They want movement. So they force trades in the middle of ranges. They enter without confirmation. They convince themselves a weak setup is close enough. Impatience slowly drains the account trade by trade. Then comes over leverage, the silent killer. You risk 10%, 20%, sometimes even 50% of your account on one idea because you're sure. It looks perfect. The confluence is strong. The bias is clear. But no setup is guaranteed. One loss with heavy leverage wipes out weeks of discipline. And now you're emotionally destabilized. Now you're not trading, you're reacting. Emotional revenge trading follows quickly. A loss hits your ego. It feels personal. You want it back. Not tomorrow. Not gradually. Now, so you jump into the next setup without proper confirmation. You increase lot size. You abandon your rules. You tell yourself you're being aggressive. In reality, you're being emotional. The market doesn't care about your need to recover. It simply continues doing what it does, and you dig deeper. Lack of structured rules quietly amplifies all of this. If your system isn't clearly defined, your brain will fill the gaps with emotion. If your entry criteria are vague, you'll justify almost anything. If your risk management rules are flexible, you'll bend them under pressure. Structure protects you from yourself. Without it, every decision becomes negotiable. And when everything is negotiable, discipline disappears. Inconsistent execution is the final blow. You follow your plan perfectly for 3 trades. Then you deviate on the 4th. You skip a valid setup because the last one lost. That skipped trade becomes the big winner. Frustration grows. You take the next trade impulsively. It loses. Now your confidence is shattered. Not because the system failed, but because you failed to execute it consistently long enough for its edge to play out. Why do most traders never admit this? Ego. It's painful to accept that the problem isn't external. Blaming the market feels easier. Blaming manipulation feels safer. Saying, brokers hunt stops, protects your pride. Saying, smart money trapped me, keeps your self-image intact. Because if the market is the villain, you remain the victim. And victims don't have to change. But the market is neutral. It does not target you personally. It does not know your entry price. It does not care about your stop loss. It simply moves based on liquidity, order flow, and collective participation. When you lose, it is not punishment, it is feedback. And most traders refuse to read that feedback honestly. Growth begins where excuses end. The moment you stop blaming and start analyzing yourself is the moment real transformation starts. Review your trades not just for technical mistakes, but behavioral ones. Did you follow your risk rules? Did you wait for confirmation? Did you trade according to your plan, or according to your mood? The turning point in a trader's journey is subtle but powerful. It's the day the question changes. The day you stop asking, what strategy should I use? And start asking, how do I execute flawlessly? That shift changes everything. Because now you're not chasing secrets. You're building discipline. You're not looking for shortcuts. You're developing structure. You're not trying to outsmart the market. You're trying to master yourself. Flawless execution doesn't mean zero losses. It means taking every valid setup without hesitation. It means respecting your stop loss without negotiation. It means accepting that a single trade is irrelevant. Only a series of trades matters. It means understanding that consistency in behavior creates consistency in results over time. When you truly accept that you are the variable, everything becomes clearer. You realize that profitability is less about predicting the next candle and more about controlling your reaction to it. You understand that the edge is not just in the chart. It is in the discipline applied to the chart. You begin to see that trading is a performance profession. Like an athlete, like a surgeon, like a pilot, preparation, rules, repetition, and emotional control determine the outcome far more than raw knowledge. Most traders will continue searching for the next strategy. They will continue tweaking indicators. They will continue blaming volatility, news, institutions, or bad luck. And they will continue experiencing the same cycle of hope and disappointment. Because they are trying to fix the wrong problem. The uncomfortable truth is this: if you cannot follow a simple set of rules with small risk, a more complex strategy will not save you. If you cannot accept a controlled loss, a better entry will not protect you. If you cannot remain patient during consolidation, a new indicator will not create discipline. The market does not reward intelligence alone. It rewards consistency. And the real work begins the moment you look at your trading results and say, without defensiveness, without excuses, without blame, the strategy is not the issue. The execution is. Most traders don't realize the real damage isn't coming from one big catastrophic mistake. It's coming from a pattern. A quiet, repeated behavior that slowly drains the account while you blame the strategy, the spread, the volatility, or the news. The hidden mistake destroying your account is not lack of knowledge. It's overtrading fueled by emotion and weak risk control. Overtrading is the silent killer. You don't need more trades. You need better trades. But your brain doesn't like that idea. Your brain craves stimulation. Charts are moving. Candles are forming. Price is fluctuating every second. It feels like opportunity is everywhere. So you convince yourself that activity equals productivity. If you're not in a trade, you feel like you're missing something. If you're flat, you feel behind. If you close your platform without placing at least one trade, it feels like you wasted the day. Overtrading is rarely about logic. It's about boredom. You open the charts with no real plan. The market is slow, nothing is clean, no strong structure, no clear level. But you keep staring at the screen. After an hour, your mind starts manufacturing setups. A tiny breakout suddenly looks meaningful. A weak pullback feels tradable. You lower your standards just to participate. And every time you lower your standards, you lower your edge. Then comes fear of missing out. You see a candle explode without you. Price runs 50 pips in one direction. Social media traders post profits. You feel late. You feel slow. You feel like the market moved without your permission. So you jump in at the worst possible moment. At the top of momentum, at the bottom of panic. Not because your system told you to, because your emotions did. And when price retraces, as it often does, you're trapped in a trade you never should have taken. There's also addiction to action. Trading triggers dopamine. The anticipation before entry, the rush when price moves in your favor, the tension when it approaches your stop loss. It feels intense, alive, engaging. Sitting on your hands waiting for a high probability setup feels boring compared to that. But the market rewards patience, not activity. Professionals can go hours, sometimes days, without taking a trade. They are not paid for clicking buttons. They are paid for precision. Now let's talk about the emotional trading cycle that quietly compounds the damage. It usually starts small. You take a loss, a normal loss, a planned loss within your rules. But it still stings. You were confident. The setup looked clean. You imagined the profit already. When it hits your stop, frustration rises. Not because the loss is large, but because your expectation was larger. That frustration quickly turns into a subtle need to recover. You tell yourself you're still disciplined. You tell yourself the next setup is even better. But this time, without fully realizing it, you increase your lot size slightly, maybe from 1% risk to 3%. Maybe you widen your stop but keep the same lot size. Maybe you take a setup that only partially meets your criteria. You enter faster, you analyze less, you want redemption. If that trade loses, the emotional pressure multiplies. Now, it's not just about strategy, it's about your ego. You feel challenged. You feel like the market is against you. You increase size again. You take an impulsive trade outside your plan. Bigger loss. Heart rate up. Focus down. Discipline gone. And the cycle repeats. This isn't strategy failure. It's emotional instability disguised as confidence. The dangerous part is that this cycle feels logical in the moment. You justify every decision. This level is strong. The trend is clear. It can't go much further. But underneath the reasoning is urgency. And urgency in trading is almost always expensive. Now let's talk about the foundation most retail traders ignore: risk management. Professional traders focus on one thing first: capital preservation. Not maximizing profit. Not catching every move. Not being right all the time. Protecting capital. Because without capital, there is no next trade. There is no long-term edge. There is no comeback. If you risk 10% per trade, you are not trading. You are gambling. 2 or 3 consecutive losses, which statistically can happen even with a strong system, and your account is severely damaged. A 50% drawdown requires a 100% gain just to break even. That mathematical pressure alone destroys emotional stability. When the risk per trade is too high, every candle feels personal. Every tick feels threatening. You cannot think clearly when survival feels immediate. If you risk 2% per trade, everything changes. A losing streak becomes manageable. You can take 5 losses and still be calm. You can execute the next setup without fear. You give your edge time to play out over a series of trades. Trading is not about winning every time. It's about surviving long enough to let probability work in your favor consistently. Most traders say they understand risk management. Very few actually practice it with discipline, because small risk feels slow. It feels boring. It feels like progress is invisible. But compounding only works if you stay in the game long enough. Now let's address why small losses feel so big. It's rarely about money. It's about identity. When you lose, you don't just see a red number. You feel wrong. You feel incompetent. You feel exposed. Your ego attaches your self-worth to the outcome of a single trade. And when that trade fails, it feels like you failed. This attachment is toxic. A loss in trading is not a verdict on your intelligence. It is not proof you're bad at this. It is a business expense, nothing more. Every business has costs: rent, salaries, inventory, marketing. In trading, losses are operational costs. You pay them to access opportunity. The moment you detach your identity from the outcome, clarity returns. When you stop needing every trade to validate you, patience becomes easier. When you accept losses as part of the statistical distribution, revenge becomes unnecessary. When you understand that your job is not to predict perfectly, but to execute consistently, pressure decreases. The hidden mistake destroying your account is not that you don't know enough. It's that you act too much, risk too much, and feel too much per trade. Overtrading erodes your edge. Emotional cycles amplify small setbacks into large drawdowns. Poor risk management turns normal variance into catastrophe, and ego transforms minor losses into personal attacks. Most traders believe they have a system. In reality, they have a collection of opinions. A few indicators on the chart, some ideas about support and resistance, a vague understanding of good risk-reward, and a lot of decisions made in the moment. That's not a system. That's improvisation under pressure. If your results are inconsistent, it's not because the market is random. It's because your behavior is random. A real system is not just an entry signal. It is a complete structure that removes guesswork when emotions rise. A real system includes clear entry rules. Not "this looks good," but specific conditions that must be present before you click buy or sell. It includes defined exit rules. Not "I'll close when it feels right," but predetermined take, profit logic, or structure-based targets. It includes strict stop-loss rules. Not "I'll see how price reacts," but an exact invalidation level that proves your idea wrong. It also includes fixed risk percentage per trade. If your lot size changes based on how confident you feel, you don't have a risk model. You have emotional exposure. And finally, it includes a trade journal. Because without feedback, there is no evolution. If even one of these components is missing, you are not executing a structured system. You are reacting to the chart in real time and hoping your instincts are correct. Hope is not a strategy. Structure is. The biggest difference between struggling traders and consistent traders is not intelligence. It is documentation. The power of a trading journal is massively underestimated because it feels boring. It doesn't give dopamine. It doesn't show instant profit. But it quietly builds awareness, and awareness builds control. If you don't track your trades, you can't improve. You can't fix what you don't measure. Memory is biased. After a few weeks, you won't accurately remember why you entered a trade. You'll rewrite the story in your head to protect your ego. A journal forces honesty. Track why you entered. What exact conditions were present? Did it fully match your setup or only partially? Track what you felt before, during, and after the trade. Were you calm, hesitant, overconfident, frustrated from a previous loss? Your emotional state matters more than you think. Track what happened. Did price respect your level? Did you exit early? Did you move your stop? And finally, track what you learned. Not just about the market, but about yourself. Over time, patterns reveal themselves. You may notice that most of your losses happen when you trade during low-volume hours, or when you increase size after a win, or when you break your rules after 2 consecutive losses. You may discover that your best trades come from one specific setup, but you dilute your performance by taking 5 other mediocre ones. Without journaling, these patterns stay invisible. With journaling, they become obvious. Structure deepens further with what can be called the 3-layer discipline model. Most traders try to fix discipline at the surface level. They say, "I need more patience." But discipline is layered. If one layer cracks, the entire framework weakens. Layer 1 is market discipline. This is the ability to trade only your setup. Nothing else. No exceptions. No, almost. If your system requires a break of structure and a retest with volume confirmation, then that is the rule. If the retest doesn't happen, you don't trade, even if price explodes without you. Market discipline means accepting missed opportunities as part of the game. It means understanding that not every move belongs to you. Layer 2 is risk discipline. This is non-negotiable. You never break your risk rules. Not after a loss, not after a win, not when you're sure. If your maximum risk per trade is 2%, then it is 2% on your best day and your worst day. The moment you allow flexibility in risk, emotions start influencing position size. And when emotions control exposure, volatility in your equity curve increases dramatically. Layer 3 is emotional discipline. This is the hardest layer because it requires self-awareness. No revenge trading, no impulsive entries. No doubling down because you feel it's about to reverse. Emotional discipline means recognizing internal triggers before they translate into external actions. It means stepping away from the chart when frustration rises. It means protecting your mental capital as seriously as your financial capital. Miss one layer and structure collapses. You can have a strong setup, but if you break risk rules, long-term survival disappears. You can manage risk well, but if you trade random patterns outside your system, your edge vanishes. You can follow rules technically, but if you let emotions push you into overtrading, consistency fades. All three layers must work together. Then comes one of the most powerful yet ignored principles in trading, the one setup rule. Most traders are obsessed with variety. They want breakout strategies, reversal setups, scalping models, swing structures, news plays, and trend continuations, all at once. They think more tools mean more opportunities. In reality, more tools create more confusion. Master one setup. Trade it for 90 days. Ignore everything else. When you focus on one setup, something powerful happens. You start seeing it everywhere. You understand its behavior in different market conditions. You recognize when it works best and when it fails. You gather real statistical data instead of emotional impressions. Depth beats variety every time. Variety feels exciting. Depth builds confidence. When you trade one setup repeatedly, you remove uncertainty about what to look for. Decision fatigue decreases. Execution becomes faster and calmer. You no longer hesitate because you've seen this exact pattern dozens of times before. You stop chasing every candle because you know exactly what qualifies and what doesn't. Structure is not restrictive. It is freeing. It reduces noise. It eliminates guesswork. It protects you from your own impulses. When you move from random decisions to defined processes, trading shifts from chaotic to controlled. And when control increases, emotional volatility decreases. When emotional volatility decreases, execution improves. When execution improves, results begin to align with potential. The structure you're missing is not complicated. It's simply strict. Clear rules. Consistent tracking. Layered discipline. One mastered setup. Most traders don't fail because the market is unbeatable. They fail because their approach has no foundation strong enough to survive pressure. The mindset shift that changes everything in trading is not technical. It's psychological. It's the moment you stop obsessing over money and start obsessing over process. Most traders enter the market with one dominant goal: get rich. Fast. They calculate how much they could make if they just catch one big move with a large position. They imagine turning a small account into financial freedom within months. That fantasy creates pressure, and pressure destroys performance. Stop trying to get rich. That sentence feels uncomfortable because money is the reason you started. But the paradox is this: the more you chase money directly, the more it escapes you. When your primary focus is profit, every trade carries emotional weight. Every loss feels like failure. Every missed move feels like regret. Every small win feels insufficient. You become reactive instead of rational. Shift your focus to process. Process means executing your rules exactly as defined. It means showing up prepared. It means taking only qualified setups. It means respecting risk parameters without exception. Consistency becomes the objective. Controlled execution becomes the standard. Money becomes a byproduct of disciplined behavior, not the daily target. When process is the goal, your emotional state stabilizes. You judge yourself based on rule, following not on whether the trade won or lost. A losing trade executed perfectly is a success. A winning trade taken impulsively is a failure. That shift alone rewires your entire relationship with the market. To fully internalize this, you must start thinking like a casino. Casinos don't panic when one customer wins big. They don't close operations because of a single unlucky night. They understand one core principle: long-term edge. Every game in a casino has a small statistical advantage built into it. Not 100%. Not guaranteed per round. But over thousands of rounds, the math works in their favor. You must think in probabilities the same way. A single trade means nothing. It is one event in a large sample size. It carries no emotional significance beyond its execution quality. But most traders treat every trade like a final exam. They need it to win. They want it to validate them. They attach meaning to randomness. When you start thinking in terms of 100 trades instead of one, your perception changes. A loss is simply part of the distribution. Even with a strong 60% win rate, you can experience 5 or 6 consecutive losses. That doesn't mean your system is broken. It means variance exists. The casino doesn't adjust its rules after a few unlucky spins. It trusts the math. You must trust your edge the same way, but only if it is clearly defined and consistently executed. This probabilistic thinking reduces emotional spikes. You stop reacting dramatically to short-term outcomes. You start evaluating performance over batches of trades. Did you follow your rules across the last 20 trades? Did you maintain risk discipline? Did you avoid impulsive entries? These questions matter more than whether the last candle went your way. Emotional neutrality becomes the next evolution. The goal in trading is not excitement, it is calm execution. If trading feels intense every day, something is wrong. Either you're risking too much, or you're overexposed, or you're emotionally attached to outcomes. Professional trading should feel almost boring, methodical, repetitive, structured. When your heart rate spikes every time price approaches your stop loss, that's a signal. When you constantly check your phone to see if the trade is in profit, that's attachment. When you feel euphoric after a win and crushed after a loss, your identity is entangled with results. Emotional neutrality doesn't mean you become robotic. It means your internal state remains stable regardless of short-term fluctuation. One practical test is this: if you can't walk away from the screen after placing a trade because you're too anxious, you're likely risking too much. Proper position sizing creates emotional distance. When risk is controlled, losses are tolerable. When losses are tolerable, fear decreases. When fear decreases, decision-making improves. This calmness compounds over time. You begin to see the market more clearly because your judgment isn't clouded by urgency. You wait for clean setups. You skip marginal ones without regret. You don't feel compelled to recover quickly because recovery is built into the long-term plan. Patience then transforms from a cliché into a competitive advantage. Most traders quit early. They expect fast results and lose motivation when progress feels slow. Most traders overtrade because waiting feels uncomfortable. Most traders lack discipline because structure feels restrictive. Simply by being patient, you move ahead of the majority. Patience is not passive. It is active restraint. It is the deliberate decision to do nothing when conditions are not aligned. It is closing the platform instead of forcing a trade. It is waiting for price to reach your predefined level instead of chasing momentum. In a market driven by impulse participants, patience creates clarity. The truth is, the bar to outperform most traders is lower than you think. You don't need extraordinary intelligence. You don't need secret indicators. You need emotional stability, probabilistic thinking, and structured patience. While others are chasing every candle, you wait. While others are doubling down to recover losses, you maintain fixed risk. While others are celebrating single wins, you are tracking long-term performance. This mindset shift doesn't make trading easier overnight, it makes it sustainable. It removes desperation. It removes urgency. It replaces emotional highs and lows with steady execution. When you stop trying to extract money from every session and start focusing on flawless process over large sample sizes, pressure dissolves. The market stops feeling like an enemy and starts feeling like a statistical environment. And within that environment, your job is no longer to predict perfectly or win constantly. Your job is to execute consistently, manage risk intelligently, think in probabilities, remain emotionally neutral, and allow patience to separate you from the crowd that keeps repeating the same impulsive mistakes. This is where everything comes together. Not motivation, not hype, not another strategy. A complete reset, a real blueprint if you've recognized yourself in the previous mistakes. Overtrading, emotional reactions, weak structure, inconsistent discipline, then this is your fix, not a temporary boost. A structural rebuild. Step 1 is uncomfortable but necessary. Reset everything. Pause trading for 7 days. Not 1 day. Not just today because I had a loss. A full week. No lev trades. No revenge entries. No random scalps. Step away from execution and step into analysis. Review your past losses calmly. Go through them one by one. Not to blame the market, but to study yourself. Where did you break rules? Where did you increase size? Where did you enter without confirmation? Identify emotional triggers clearly. Was it boredom? Was it fear of missing out? Was it frustration after a loss? You cannot fix what you refuse to confront. This reset week is not weakness. It is professional recalibration. During this reset, something powerful happens. The emotional charge around trading decreases. You begin to see patterns that were invisible while you were in the heat of the moment. You realize many losses were not strategy failures. They were execution failures. Awareness is step 1. Without awareness, discipline is impossible. Step 2 is defining non-negotiable rules, not flexible guidelines. Not, I'll try. Non-negotiable. Write them down physically or digitally. Your max risk per trade must be fixed, ideally 1% or 2%. No adjusting based on confidence. Confidence is emotional. Risk must be mathematical. Define your max trades per day. If your edge produces 1 or 2 quality setups daily, why are you taking 6 trades? Overexposure creates emotional instability. Set a maximum daily loss. If you hit that number, you stop trading for the day, no exceptions. This rule alone can save accounts. Then define your exact entry criteria. What must happen before you enter? Break of structure. Retest, volume confirmation, specific candle close. Write it clearly. If the conditions are not fully met, you do not trade. No flexibility. No almost. No emotional interpretation. Rules only work when they are rigid under pressure. Most traders fail here because they secretly want freedom. They want room to improvise. But flexibility under emotion becomes self-sabotage. Structure protects you from yourself. The stricter the rules, the calmer the execution. Step 3 is where ego gets challenged. A trade small. Reduce your lot size drastically. So small that losses don't hurt. So small that wins don't excite you excessively. You are not trying to grow the account right now. You are trying to rebuild discipline. This is where most traders struggle because they equate small size with small ambition. That's false. Small size builds large stability. If you can't control small money, you can't control big money. If a 50 loss frustrates you, a 500 loss will destabilize you. If you break rules with a small account, you will destroy a funded account. Discipline is scale independent. It must be proven at the smallest level first. When risk is small, your mind stays clearer. You can follow rules without emotional pressure. You can observe your behavior objectively. This phase is about proving to yourself that you can execute 20, 30, 50 trades without breaking structure. Not perfectly, but consistently. Small position size reduces fear. Reduced fear improves decision quality. Improved decision quality builds confidence rooted in process, not profit. Step 4 is weekly review. Every weekend, sit down and evaluate honestly. Did I follow my rules? Not, did I make money? Did I follow rules? Where did emotions interfere? Did I hesitate on valid setups? Did I overtrade after a win? Did I stop trading after hitting max daily loss? What needs refinement? Maybe your entry criteria need more clarity. Maybe your trading hours need restriction. Maybe you trade better during specific sessions. Growth comes from review. Without review, mistakes repeat unconsciously. With review, patterns become visible. When patterns become visible, adjustments become strategic instead of emotional. This weekly process transforms trading from gambling into performance optimization. You become less reactive and more analytical. Over time, these reviews compound. You notice fewer emotional spikes, fewer rule violations, more consistency. Even if profits are modest initially, stability increases, and stability is the foundation of scalability. Step 5 is the final mental shift. Think long-term. Trading is not a one-month goal. It is not a quick flip. It is not a lottery ticket. It is a multi-year commitment to skill development, emotional control, and structured execution. When you compress expectations into short timelines, you create pressure. Pressure leads to over-leverage. Over-leverage leads to drawdowns. Drawdowns lead to desperation. When you expand your timeline to years, everything slows down mentally. A bad week becomes insignificant. A losing month becomes data. You stop chasing immediate transformation and start building professional habits. You treat trading like a business. Businesses focus on risk management, process improvement, and sustainability. They don't bet everything on one event. This blueprint is simple but powerful. Reset to remove emotional noise, define rigid rules to eliminate ambiguity, trade small to build discipline, review weekly to refine performance, and think long-term to remove urgency. None of these steps are glamorous. None of them promise instant wealth. But together, they create something far more valuable: consistency. When you commit to this structure, trading stops feeling chaotic. It becomes methodical. Losses become manageable. Wins become expected over time instead of desperately needed today. You stop searching for the next strategy and start mastering execution. You stop reacting emotionally and start operating professionally. The complete fix is not external. It is behavioral. Follow this blueprint with patience and honesty, and over time your results will begin to reflect the structure you finally built.